In today's video, I am going to be breaking down my favorite and top high dividend tech ETFs. Now, this is a video that's going to be very interesting to a lot of dividend investors because traditionally, just tech stocks don't pay dividends all that much. So what is classified as a high dividend tech ETF? You're going to have to watch and see because some of these are actually pretty crazy. So let's get down and let's check them out. This first one is TXF. It is a CI Tech Giants covered call ETF. What a covered call means, if you are a beginner when it comes to investing, is basically you'll have your 100 shares as an example of, let's say, Apple, and you would then sell a call option against those 100 shares at a future price. So if they're currently, let's say, $20 a share, hypothetically, and you think that they won't hit $40 a share in 6 months, then you can sell a call option, make some premium on that call option, and somebody will be betting that, of course, the stock's going to hit $40. If it doesn't hit $40, you keep your premium. Let's say the premium was $20, and then you also keep your shares, and that is what's paid out as a yield, or technically a dividend, but it's not a dividend. It's, of course, capital gains, but don't worry about that part. Basically, you're getting a higher dividend. The MER is 0.7%, which is in line with pretty much every other covered call that's on the market. It has been around for quite some time, and its quarterly distribution is pretty strong in my opinion. And calendar year performance is really strong, by the way. You won't usually see this with regular covered calls where you'll have a 30% year backed up by a 25% year that basically was following another 20+% year. You're not generally going to see that kind of performance on a regular covered call. This is why I really like this ETF. Its distributions are quite large as well. You're looking at an 8% over the last 12 months of this ETF paying dividends, 8% dividend over the past 12 months. That's really strong in my opinion. When it comes to the portfolio, the asset and geographical locations are pretty interesting. Obviously, it's mostly United States, but there are some other countries that are on that list. Quite notably, Canada does have some tech stocks. Surprising, isn't it? However, the top holdings are as follows. Micron Technology is currently number one. These do generally move around quite a bit, but Apple is going to be another one. One of the top ones I really like on this list, however, is Texas Instruments and Apple. Those are the two companies that I really love on this list. AMD is also another one. Anything to do with computer chips is going to be absolutely amazing. Intel is another one. There's a massive computer processing shortage, and because of that, I really think that some of these companies can really do super well. And if we look at the chart way back to 2017, we can really see it's done quite well. It was trading within a range for a while. However, this recent spike is absolutely amazing. It's had even a little bit of a pullback like pretty much every other tech stock and ETF. So this could potentially be a good time to get in. It really does depend on your risk tolerance when it comes to the world right now. Next is ZWT, which is another covered call strategy. This one's by BMO, so a little bit more well-known of a name, in my opinion. Whenever I mention the CI Tech Giants covered call ETF with my friends, they tend to look at me and say, who runs that? So at least with BMO, if you were to mention this to a friend and ask them, hey, what do you think? At least the one thing they're going to say is, yeah, I've heard of BMO before. It's a pretty large bank. So always get multiple opinions. Don't just trust one person, and also do your own research. Always. Never listen to those people down in the comment section that say, buy Bitcoin, buy Bitcoin, buy Bitcoin from me. But either way, basically, these ETFs are holding tech stocks and they're selling covered calls against them. This one's annualized distribution yield is a little bit lower than the last one, this one being 5.5% right now at the time of making this video. Now, the benefit of a covered call ETF is because now you're basically protecting your downside risk to, of course, the sector that covered call is covering. However, at the same time, you're limiting your upside. So essentially, in a market where the stocks are going essentially sideways and slightly up, that is kind of the best benefit to a covered call, because then you're getting a larger dividend to offset what's going on in the market. And right now, I think that's why there's massive volume going towards covered call ETFs. We've seen this volume spike over the past year. And I think it's not just because there's more and more people investing in covered calls. I think it's because these big institutionalized investors are really starting to look at the market and say, there's a lot of risk here. I don't think there's going to be too much of an upside right now. And they're starting to kind of run the covered call strategy for a little bit. Everyone wants to kind of fall away from the stock gains and kind of go towards the income strategy, and I think that's what is happening with the market right now. That's probably why this channel blew up so fast as well. This one's expense ratio is a bit higher at 0.73%, and this one also does not pay a quarterly dividend. It pays a monthly dividend. So that is going to be fantastic. Let's say you are self-employed, or if you are retired, this can kind of give you that monthly regular paycheck as you normally would be having if you worked a job. So if you are looking for income supplement or income replacement, this is definitely one option for you. Both of these are medium risk tolerance, whatever that means. And in my opinion, I've seen some really safe ETFs that were risky high. I don't pay attention to this. I just go like this and say, nope. And yes, if you're Canadian, you can invest in this in multiple different ways. Personally, I hold this one in both my TFSA as well as my RRSP. And if you want to see a great video about those, go check out my channel. This one is currently paying 13 cents per share per month, so that's not too bad. If you are a person who is a really big number person who doesn't like the number 13, stay away from it. This one does have different top holdings as well, mostly in a way. So of course it still has Apple and it still has Amazon, but if you compare the two lists, Amazon on TXF is much lower, and of course on this one it's much higher. However, this one does have Nvidia at a much higher level, and I actually agree with that. That's actually a fantastic option because Nvidia, I think, is going to continue to have high growth, especially with more meta world stuff happening. Nvidia is going to have a large role to play when it comes to the graphics cards and processors and things like that. Of course, Apple is not going anywhere. Whenever you've got a company that can basically say, we feel like pricing something at whatever price point and people are going to buy it, you generally want to buy that company. That has massive pricing power that everybody wants in their business. Visa and MasterCard are probably going to have some issues because, of course, they pulled out of Russia, which means that they probably lost at least a little bit of money there. So overall, still a very good list. And if you're looking to invest in an individual tech stock that pays a little bit of a dividend, I would definitely be looking at Apple. I know this is obviously not a high dividend strategy option to be able to go after and buy, but I'm going to tell you right now, Apple, yes, they do raise their dividend occasionally, but what you're getting is just massive growth and pricing power. They're not going anywhere anytime soon. They're also probably making a higher margin on their computers now because they use their own processors. They don't go after Intel and say, here's an ungodly amount of money for your processors that do exactly what we can already develop. So because of that, I think Apple is basically one of the top companies in the entire world, even though they are the largest company in the world. But overall, these are the two ETFs that I would recommend if you were looking for a tech high dividend ETF, because now you can get the growth, but also you can get high dividends. And personally, I wouldn't just hold one or the other of these. I would kind of hold both of them, in which I do hold both of these ETFs myself. So make sure to always do your own research. Know what other people are holding when they're trying to push an ETF or a stock. I personally don't individually hold Apple anymore. I used to. However, I do hold both of these ETFs. Anyways, I hope that you've enjoyed today's video. If you have, hit that like button, subscribe, and I'll see you guys again next time.